Hello and welcome viewers. I am Hiral Dadia. Today we are going to discuss Beyond Markets, which is the monthly magazine by Nirmal Bang. In fact, it covers global as well as domestic stock market events, economic updates and analysis. In fact, it also gives you a detailed analysis of other financial products like commodities, insurance as well as mutual funds. In fact, let's talk about the Feb 2020 edition that focuses on the power of three. We will be picking up one topic out of the magazine first, which we will be taking under discussion. The first one is thinking out of the box. Let's understand why such a name to the entire article. This is because you have RBI, which has now started to use innovative tools to push credit growth. In fact, they have been using innovative tools to also ensure that policy transmission is happening in the system. Now, higher inflation is something which has actually gone ahead and capped the MPC's ability to lower the policy repurchase rate, that's the repo rate. To understand more and get a detailed analysis of this, we have Teresa John, who's the economist at Nirmal Bang, joining us. Teresa, welcome to the show. Firstly, we've just been talking about how difficult it's becoming for the RBI and the MPC to, actually lower the policy repo rate. What's your first reaction to it?
Yeah, so the RBI and the MPC has actually, been proactive and already reduced the rate by 135 basis points. And now inflation has started going up from December. So to that extent, their ability to reduce rates further has been capped, as you rightly mentioned. So now the MPC and the RBI is actually waiting for banks to transmit some of the rate cuts that have been implemented on the policy repo rate to the lending rate. So even the MCLR, which is the benchmark lending rate, has come down only by 50 basis points, although the RBI has cut by 135 basis points. So that is why the RBI has now forced to take some unconventional measures to ensure that policy transmission actually percolates into the system.
Right. So if you could just help us understand any specific measures that are outside the MPC's domain that the MPC is now using.
So the MPC's domain is mainly to take action on the policy repo rate.
Correct.
And depending on the stance of the MPC, so right now the stance is accommodative.
Accommodative, correct.
The RBI will use other instruments to ensure that the MPC's accommodative stance is translated into the system. So one of the measures that they have been using since June is that there's been surplus liquidity in the system. So if you look at today, there's over 2.5 lakh crore worth of liquidity in the system. But you still haven't seen, despite the surplus liquidity in the system, lending rates haven't come down. So that's why they're now looking at your operation twist and your long-term repo operations and the CRR exemption that they introduced in the latest. As an addition to the
Correct.
MPC tools.
Right. So let's highlight three of them. As you mentioned, access of cheap funds to banks for a period of up to 3 years. That's one thing that we're looking at, as you mentioned. Relaxation in the CRR is something that we're looking at. And thirdly, buying long-term maturity bonds while simultaneously selling the short-term maturity instruments. Now, these three are the specific ones that we are highlighting. Now, what are the reasons why the RBI is using such innovative tools?
Yeah, so the last point that you mentioned about buying long-term securities and selling short-term securities, that actually it started even before the February MPC and the RBI meetings. So it actually started as early as December 2019. And the reason why the RBI has started doing this is because in December, generally the market expectation was that the RBI would cut by further maybe 15 to 25 basis points, and then kind of signal that there's no further space to cut because inflation is going up. But the RBI actually paused in December itself. And then you have the inflation reading coming out, which is moving higher to closer to 5%, and subsequently moved up to over 7%. So as a result of that, your bond yields actually moved up, and your the repo and the 10-year bond spread had gone up to around over 160 basis points. The long-term average is around 80 basis points. So the RBI clearly was uncomfortable with the repo and the 10-year bond spread being so high. So that is the reason why they actually started doing this operation twist.
Correct.
So and consequently, the 10-year bond yields did come down, and today they're well below 6.5%, around actually closer to 6.3%. So, I mean, that's partially because of the coronavirus impact and global bond yields coming down, but it also reflects the operation twist that has been conducted by
Right.
the RBI.
And if we talk about Operation Twist as well, if I'm not mistaken, 5 tranches of Operation Twist is something that has already been undertaken by the RBI so far, right?
Yeah, so actually they've done 4 tranches.
Okay, 4 tranches.
Yeah.
And overall, do you think this will actually help lower the long-term funds to boost economic growth?
Yeah, so the idea behind this was to bring down the 10-year bond yield, because that is the benchmark for, you know, whether it's a corporate bond, pricing of the corporate bond, and even pricing of a lot of the other instruments in the economy. So to that extent, yes, it did help bring down the cost of funds in the economy.
Right. Apart from that, if you talk about the long-term repo operations, that's the LTROs, what's the analysis on that front? Because from the 15th of February, you have the banks which have an access to almost liquidity worth 1 trillion rupees from the RBI. And this will come in at a repo rate of 5.15%, which is almost 100 basis points lower at what they borrow currently from the banks, right? So, taking this into consideration, how do you think it will help banks and in turn the corporates?
So the intention of the LTRO is primarily was to transform liquidity from the shorter end. So as I mentioned, there's a liquidity of around 2.6 lakh crore in the system. But banks are not sure for how long that will be available. So this LTRO, what it actually does is to ensure that the funds are available for a period of 1 year and a period of 3 years, because that's when the banks will have to actually repay the RBI. It ensures liquidity to the banks which will kind of enable them to cut the deposit rates. Because otherwise, one of the banks have been complaining that deposit rates are sticky, and if they're not able to reduce deposit rates, and that hence they're not able to reduce the
Yeah, and if
lending
they
rates in the
reduce it
system.
without getting a lower cost of fund, it will impact their margins and profitability as well.
Yeah, that's right. I mean, there are few banks, I mean, because they have a larger chunk of your, what do you call it, CASA, your current account and savings account deposit, which, if you have a higher CASA ratio, you could have slightly lower cost of fund,
Correct.
but the 1 year interbank rate is around 6.1%. So for mainly for the medium to smaller size banks, this will ensure liquidity is available for a longer period of time, and at a lower rate of interest, which will kind of incentivize them to also lend at a lower rate of interest.
Right. And lastly, if we talk about the sector specific relaxation that we've been talking in terms of CRR. Now, with this, the banks will enjoy lower outgo in their CRR requirement, and the dispersal is especially, to the MSME sector, MSME space. Now, which are the sectors do you think that will benefit out of this?
So there are 3 sectors which are mentioned in the RBI circular for the CRR exemption. So one is auto, one is auto, housing, and so which comes under the broad retail, and the micro, small and medium enterprises. So if you broadly classify, this is largely the retail sector that will benefit. It's not going to large corporates. So the idea is that possibly by lending to housing or to the auto sector, you have a larger amount of credit availability that will possibly boost demand.
But right now, if you go to see, they're already in doldrums, especially the real estate as well as the auto space as a sector. And this entire sector specific relaxation in CRR is available only till July 2020. Do you think there is a possibility that RBI probably would have to extend these benefits to the sector, because you already have natural calamities? You have something like a coronavirus which has come in, which is also impacting these sectors as a whole and the economy as a whole. Do you think there is a possibility where they might have to extend it beyond July, and do you think they will be open to it?
Yeah, so on your first point, it's precisely because these real estate and auto sector is in doldrum, that is why the RBI is implementing this. So this will go to the, it will not go to the sector, it will go to the buyer.
Okay.
So the buyer or the of a house or the buyer of a car. So to that extent, it is to help the auto sector or the real estate sector and to bring back demand. I agree with you that probably 6 months is a too short a window. There is a possibility that they could extend it. As of now, they haven't given any commitment. But if the credit offtake actually improves because of this exemption that has been given and translates to higher demand on the ground, there is a possibility that they will extend it.
Right. So, as you're saying that these are not really tested measures, do you think there is a possibility that these measures could be inflationary in nature and could again backstab?
No, so I mean, in traditional economics, if you have a high amount of liquidity, you could say it's potentially inflationary. But the current situation that we have in the Indian economy is that there's been a lot of demand destruction that has happened. So a lot of the inflation is high, particularly if you look at the CPI, but that's mainly driven by supply side issues. So whether it's vegetables or your telecom tariff hikes or your drug price hikes, it's all on the supply side. It's not demand driven. So to that extent, I don't think the surplus liquidity in the system or the LTR or the operation, so any of the measures that the RBI is currently taking will be inflationary in the short term. If the economy picks up, then I mean, obviously these measures will have to be withdrawn. But in the short term, I don't think it's inflation.
Right. And very lastly, will these short-term moves that the RBI is doing work when all of these bottlenecks facing the economy are actually structural in nature then?
Well, actually, as I said earlier, I mean, it's important to bring back demand in the system at this current point. So, part of it is structural, part of it is cyclical, and what the RBI is trying to do is to bring back demand in the system. I mean, by ensuring availability of credit.
Credit.
And so, to that extent, I think this is necessary. The structural issues will have to be taken care of by the government, not so much by the, so whether it's land and labor issues. The government has introduced the corporate tax cut, which is again a structural in
Correct.
nature, which will take some for that to actually kind of trickle through the economy. But I think at this current point in time, we needed some demand boosting measures, and to that extent, what the RBI has done is probably the right thing.
Right. So thinking out of the box is pretty much true for the RBI right
Yeah.
now. Thanks, Teresa, for joining us. So clearly, we have given you a detailed analysis of how RBI is actually thinking out of the box to boost demand, to push the credit growth into the system, and ensure that the policy transmission is happening from the banks to the consumers as well. That's all that we have from the first article of Beyond Markets, which is the monthly financial magazine by Nirmal Bang from the Feb edition. Thanks for watching.